Welcome, everybody, to another trading show. This is Thursday, October 20th, 2020. I do have my friend Scott here, but for some reason, it's showing him as still in the green room. So I'm going to figure out how to get him added here in just 1 second. Before we do that, before I forget, though, I need to remind everybody that this training is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All hypothetical examples are for the purposes of teaching principles and are not intended to suggest future results. The risk of loss in trading securities, options, futures, and forex can be substantial. You must consider all relevant risk factors, including your own personal financial situation, before trading. If at any point in time you feel like you need some additional disclaiming, you're welcome to pause this video, go back to the beginning, and reread that disclaimer from top till bottom. This is a live show. Those of you who are here with us live, I encourage you to interact, to participate. Type your comments in. We're glad to address as many of those as we can. We keep getting more and more traction. This started off as our itty-bitty little trading show here with just a couple dozen people that would watch, and we're into the hundreds now that are watching this trading show on a regular basis. And it sure helps us if you get the word out by liking, subscribing, sharing it with your friends. If you feel like something we said has been valuable to you, do us a favor and share it with somebody else so that we might grow this community even larger. All right, I need to figure out why my friend Scott won't come out of the green room here. Can you hear me, Scott? But I can't hear you. Somehow you are in... Let me figure out what's going on here. There you go. Now you're with me.
Yay, I'm back.
But all my stuff is not set up right. Try sharing your screen. Are you sharing your screen yet? Sorry, guys. These are technical challenges. We need a producer is what we need. All right, now I see your screen. So let me see if this is working. All right, so I can see your screen there. And can I see you there? I don't see you yet. I'm still working on getting Scott. I don't know. Well, we're going to jump into it here, and then we're going to figure out why Scott's video is not sharing, and I will come back and add him when he's sharing. I can see your screen, so that's the important part, and then we'll work on seeing your face, Scott. So
perfect. No worries.
So I blindsided Scott. We got so excited in a TSU team meeting this morning that we ran a little bit long, and I forgot to send Scott the note on what we were talking about today. So I have arbitrarily picked trading choppy markets. Does that not seem appropriate for where we have been? I want to point something out. To my knowledge, and I don't claim that I've seen and remember every single trading days back to 1997 when I started doing this, but I cannot think of a time where we had a bullish engulfing pattern that was followed up with a bearish piercing pattern that was followed up with a bullish harami pattern that was followed up with a island reversal pattern. Now, before the purists start sending in all the hate comments that they're not in the right spots in the trend, I understand that. The island reversal, for example, needs to be at the top of a bullish trend, and we're not really. At best, we have maybe a little bit of a bear market recovery-ish. We'll see what that turns into. But it was ironic. Both of my boys that live at home trade the stock market, trade real money in the stock market. And so we talk about this very frequently. And so we were talking about this day back there, and we said, wow, that was an amazing bullish engulfing pattern. And then the next day I was like, wow, that was an amazing bearish piercing pattern. Wow, that's an amazing bullish harami. It was like, what is going on? But with all that volatility, and I'm going to just set this up because I've got something I want to come back to after I let Scott share a little bit of his thoughts and what he's been hearing. All the while, the VIX is just still kind of hovering here at 30, which is high, but not crazy. If we go back to 2020, obviously, when the world was falling apart, we hit the bottom of that little bear market run with VIX up at 85. If we go all the way on back to 2008, that's the crash a lot of people remember. VIX peaked out around 96 or so. A 30, I'll hover my cursor over. 30 was just like, this party's just getting started, bro. And of course, if you're unfamiliar with the VIX, it tends to move inversely with the S&P 500. So It was not good times in paradise for those in bullish positions when the VIX was skyrocketing from 30 up to 90 back in late 2008. Of course, then the bottom came right in the beginning of 2009, and the VIX came back in line, and we hovered around 20 or 30. So here we have all this choppiness, all this volatility going on, but the VIX is just kind of a snoozer. Scott, I'll hand it over to you, and I'll share your screen on the broadcast here in case you want to share something. And I'm also going to go to work on trying to get your video working while you're commenting on all that.
Absolutely. Okay. So one of the things that I've mentioned to the Traction group has been that most of the movement you guys are seeing in the marketplace are strictly coming from one spot and one spot only. And that really is coming, I say one spot, is from one behavior in the marketplace. It's always news-based gaps. It's not like you're coming out of something that's trying to, quote, trend. So everything you guys are looking at is a reflection of this. So, oh, it's great. The market moved up today and then it stalls. To give you a different way of looking at this.
By the way, I just got your video working. It's amazing.
That's no problem. That's okay. Let me go to Market Watch. So one of the things, this is the opening range. I use the SPY, the QQQ, the DIA, and the IWM, and I've used this for over 2 decades. I'm indifferent to what indicators people use. I'm telling you, be consistent with it. But I do want to mark out one thing or make you guys aware of something. You'll notice yesterday we struggled to get through the confirmation of the opening range breakout. You'll notice today, same situation, same level. Eventually, we're going to get through an opening range breakout that's going to confirm, and the market will then hopefully start to creep higher or do what it needs to do. But I bring this up because the market has struggled for the past 3 days to do anything constructive in that regard to push. And as Josh has said, you have choppy markets. And the reason I'm mentioning this is because eventually that's going to shift. Whether it's after the election period, if they're just going to continue to base through here is perfectly fine by me. Be patient with it. Let them do what they're going to do. Just try not to keep. I see people trying to go for grand slams right now, and this is not the point in time to be trying to make grand slams happen. Is my point. Okay, I hope that helps. Back to you, Josh.
Yeah. So, the question that was on my mind as we were coming into this is what do we do with this information, and how does our trading have to adapt? So, I'm a very firm believer in designing your strategy. Plan your trade and trade your plan. But sometimes we need to make some adjustments. And what that has looked like for me and with my boys in particular is it's kind of gone two extremes. The messy middle is where, in my opinion, it's the most difficult to trade right now. And that's I'll call them short-term swings. So if you're in it for a day or 2 or 5, you can write out some pretty substantial moves that are in opposition to your trade direction. So it seems like, and I need to get some data. Maybe I'll post it on the TSU Discord for those of you that are members at TradeSmart University. I don't like the word unprecedented, and I actually don't know if this is unprecedented. But what is happening right now is the market is just slamming back and forth, and they're called in some circles all or nothing days, where 90% of the S&P moves one direction or moves another. It doesn't matter what the earnings report was or what the fundamentals were or even what the sentiment was of that sector and of that stock. It's just whichever day you wake up and the wind blows. It's like a politician, friends. Whichever direction the polls seem to be blowing, that's the direction that the stock goes. And it has worked well for me to kind of gauge that momentum at the latter part of the previous day going into the beginning of the morning, and then just ride that momentum and exit it out. To some extent, it's the morning glory strategy that I teach at TSU. But even beyond that, it's just about getting a pulse on which direction the momentum's going. And to steal a phrase from one of our instructors, put cash in your jeans when the market makes it available to you. Don't go for those home run slams like Scott's talking about. If you find yourself up 1% or 2 account wide, boom, lock that in, put the cash in your jeans, walk away from the computer, and call it a good day. That's what's worked well for me. The other side of the equation is longer term trades. So I'm transparent and candid with all my trades. Remember, my trades are not your trades. My outcomes are not your outcomes. All the disclaimers, because I know the federal regulators watch these shows candidly because they think Scott and I are hilarious and they just want to hang out with us every Thursday. But if you're a federal regulator, everybody in here knows that my results are not their results. But I've got some longer term put options. Ultimately put options on the S&P. It's a little bit more of a complicated strategy than that. But to keep things simple, I am forecasting bearish through January. That's how much time I've got on that put option. Now, the way that I structured that trade was my maximum risk allotment. And Scott will tell you I am nutty about how much I'm willing to risk on a trade. My maximum risk allotment is represented by the entire cost of that option. If it goes to zero, I've only lost what I would call 1R in my trading account. The upside potential is significant and it's already making money. And so even if I just get 30, 40, 50% return on that trade, great. Now, it's not a home run trade. It's not going to double my account as you see some of these gurus that are out there doing. But you know what? If it's easy to double your account, it's easy to half your account or take your account to zero on any one trade. So don't do that. All right. So those are just to summarize. I'm coming back to you, Scott. The middle messy. If you find yourself frustrated right now, take a look at if you're trying to trade in the middle messy, the 1, 2, 3, 5 day, even 6 or 7 day swing trades. Faster day trades, going with the momentum of the market, or longer term swing trades, 2 or 3 months to let the kind of the choppiness shake itself out. We see the general direction of the trend. And until that red box, you're not actually seeing my screen right now. Let me put it on. Until that red box on my screen is broken, you cannot convince me otherwise that we're done with the bearish trend. All right. So as long as we're in this red box, I must maintain a bias that's bearish. Well, Josh, are you going to miss the bottom? Yeah, probably. But you know how many false bottoms we didn't miss on the way on down because we just kept believing that the framework had changed when it hadn't actually told us that it changed yet. And that's my framework. And if we have got time, I can talk about how that red box is created right there. But as long as we trade to or within, but not above that red box, we're bearish, friends, in my model of the world. Now, does that mean we can't trade a little pop up to that box? It's possible if you got the right day trade strategy. So beware the messy middle. The money in my experience, my experience is in the shorter term and the slightly longer term trades. Scott, back to you, my friend.
Absolutely. Hang on. It's going to show the monthly. I'm going to show two things for everybody. So if you've been around me, you know this is kind of where I'm coming at the long-term stuff. We're pretty much in the middle of this longer-term, 13-year trend that we've been looking at, or where it's been since 2009, somewhere in that range, give or take. And that's a measured move of this most recent behavior. So this is where we had the nice rebound, the June lows. You're on the fourth wave down. We'll see what they do with this longer term. This is congestion zone right here, like 5 o'clock traffic. Okay, and we've touched on this in the past, so I won't belabor it, but I do want to drop over to the counter ranges. We will, in a couple, another 10, 11 weeks, whatever, we'll start building these again, the turn of the new year. And we'll take about 2 weeks. These will build out, and we'll talk more about those when we get to them. I only want to bring this up for one brief moment. You'll see with the small caps, and I'll enlarge this so everybody can see a little easier. You'll see we struggled right at the high of, guess what, the counter ranges. Okay, on the small caps, you go to the other market watch 4 charts that you have related to counter ranges. You go look at the rest of this, and you'll see exactly the diamonds seem to have a little more strength than the others in certain respects as far as just trying to hold through here. But what's more challenging in my mind, and everybody's used to the NASDAQ being that leader that has helped us, and it's also the one that's been hurting us along the way. But you can see where it continues to get beat up. Okay, we can't get back inside of there. So if we could recover, let's just call it 277 rounding off right now. When I say recover, guys, I get this question a lot through Trader Traction, Traction Pro, through independent traders. How do you confirm something? And there's not one absolute. Like, I can give you certain absolutes based on specific strategies. With this, you have to see how the price is acting. And the analogy I've used for people is if you've had kids, you train them how to drive the car, and, well, Dad, how much brake do I give on the traffic stop or the light? Till you stop. Well, how much gas? Until it's like, you all know that, but trying to then quantify that. The same thing with entries. I can give you specific entries to specific strategies. But when you're testing a level on a chart, like good friends in the industry has always said, it's an area on the chart. It's not an exact penny. And without getting into the nitty gritty of that, what you'll often find with this is you're getting into, yes, I can give you, technically 276.75 to the penny. The difference is, what if your data feed's a little off that day? Your server's off. Okay, so I get the desire for perfection as traders, but the best thing you can do is learn to kind of realize when you come to the little white line by the stop sign. At least where I live in the South, we have these. Maybe the rest of the world doesn't. Who knows? We live in the South. But I don't always stop exactly the bumper right at the edge of that stop, do I? No one does. You're not, unless you have a camera, and anyway, you get the point of it. That's how a lot of traders are trying to think, though. They're trying to be precision, like you need a scalpel. You need to give a little more latitude in it. They're trying to manipulate markets around. We know this. This is not new. I've watched it for 4 decades, from the time I was a kid to an adult now. So I'm only surfacing these things to help you as you trade and look at levels, regardless of how you drive your levels. But we can't seem to recover the counter ranges from July. And the Qs keep getting smacked there. The IWMs are getting smacked up here. And the small caps, by far, are the strongest on the board. The diamonds seem to be trying to hold up more recently. We'll see what happens. But I surfaced this because it's hard to trend if we're not above or below these and everybody's walking the same direction. And I demonstrate this all the time in Trader Traction. In fact, we saw it yesterday when the small caps, in fact, just to highlight this really quick, and I'll get back to Josh. But yesterday in the small caps, I'm going to get rid of today's activity just for a second here to make this easy for you to see, using nothing more than the opening range. And I find it so interesting. People dismiss this concept, and I'm going, you'll see it in forums. Oh, that's old school stuff. Yeah, it sure is. You probably should spend some serious time on it because it's still embedded in the markets. We know this. Yesterday, the small caps, the IWMs, stalled right at the 30-minute OR. The other three of these were trying to confirm their allotted time to break out based off the rules of how you look at the opening range. All three of them failed basically around the same time. And the divergent child here was the IWMs. It was a small cap saying, bye mom, bye dad, bye brother. I'm going to get the sea turtles, I say. And off little Susie went. And now comes the rest of the family going trying to get Susie. If you want a market that's going to move, you want your market watch charts to be in sync. I don't care how you reference that, but having been through day trade call rooms in my past and seeing what happens, the best examples I can give you before I hand back to Josh was a NASDAQ call room years ago. And I mean, years, way back in my career. And I would hear these guys complain, ladies complain, oh, well, the market did this to us. I'm going, just shaking my head and listening to this chatter. And all they're looking at is the Comp X. And I'm thinking, if you're not looking at the rest of the market, it's no wonder you guys are getting fraud. And you look at it, and the NASDAQ was trying to go higher, and the other three were turning and running lower. Well, the markets all tend to have the same business arena it we're playing in. So you think it's going to be different for one business the other? Okay, I'll give you that. But not with over 2,500 plus stocks that you're looking at. These are kind of birds of the feather. And so they will leave little hints. And I'm showing this on a 5-minute chart using opening range. The same thing's true on the counter range, which is based over multiple weeks and months of time. So you can use this concept no matter who you are, what level of trader you are in this industry, you can use this information. Just use it with your tools. But I have several of these, what I call Market Watch 4 charts, depending on the indicators I'm using. And it has served me well. And this is actually not opening range, but the idea of the Market Watch 4 is the very first concept I ever taught. And I still have traders 20 years later, but still this is their reference point. So is there value in it? I tend to think so. Try it, see if it gives you some help. But in these choppy markets, it will help you see these quick divergences a lot of times. Back to you, Josh.
Yeah. So we don't always do this, but I thought it might be fun to take a look at just a few stocks here and think strategically. Another way that we can hedge some of these choppy markets and not, trying to figure out how much gas to put on the accelerator is to play both sides of the fence. So here's an example. This is PepsiCo. By the way, I found this by this isn't actually, this is mislabeled here because I changed the filter. But I'm looking for stocks that had stochastic above 75. And if you're unfamiliar with the stochastic oscillator, it's a momentum, it's a trending oscillator. It's one of my favorites because it really is hard to get a extreme overbought or oversold level on stochastic for any long duration of time. And with the market that's generally trading down, if there's a stock that's above 75, it's either one of two things. It's either bucking the trend and it's trending bullish, or it's completed some kind of a rebound back up to a resistance. Hopefully, that's the outcome in this search, and it could possibly be setting up for another opportunity. Which I just realized Scott is not on this. His wonderful camera is not on this screen. You can pick your nose while it's on my chart, Scott. Can you even see the production? Like, can you see what's going out, or you just have to have faith that I'm somehow
No, I
controlling
can
it?
see. Yeah,
Okay.
we're good.
So here's PepsiCo, and we talked about this. I just extended the line. It was probably back in September, which that doesn't even mean that's when I drew the line. It might have even been back in August. I remember looking at this in a power trader. But to Scott's point just a minute ago, I'm not looking for my tablet to turn on when I want it to turn on. Well, it's loading up. I'll mouse it here. I'm not looking for a decimal point. In fact, if it wasn't so dang bulky, I would draw these support and resistance zones with boxes. But then they start to look like Scott's calendar ranges, and I don't want people to think it's that, because those are amazing. And this is just support and resistance. But up when we get into this area, let's call it 178 ish. What a great technical analysis term, ish. Well, 178 ish. Historically, going back to the beginning of the year, it has rolled over. This time it rolled over with a beautiful head and shoulders pattern. So who knows what it'll do here? Maybe it'll have a head and shoulders pattern. I don't know. But looking from a probability perspective, when it gets up here, it tends to go down there. Agreed? I think sometimes we tend to make it so much more complicated than it needs to be. When we get up here, it tends to go down there. Now, whether that's today, is it's cratering, or are we going to see a little pop up and go back down? I don't know. That's where this is the messy middle, and we may have missed this move today. You might want to see what it is tomorrow, but you could have hopped on this bandwagon and traded bearish today, or you could buy yourself a couple months worth of time, and that way, if you get a little head and shoulders pattern or whatever at resistance there, you've still got time for that to come out and complete in your favor. So taking a look at this, I think this could be a very interesting bearish trade that you guys are looking at. Even if you got in at 172 and you're targeting, conservatively down here, we could duplicate this. Clone. There's a little midway point at 161 or so. That's not a bad move. 172 down to 171. That's an $11 move with a stop. That would be roughly, put my stop right there. It's about a $10 stop for an $11 move. One little over 1-to-1 risk reward. And that's on the minimum target. You might even come all the way on down here. So we talked about position sizing last week, so I'm not going to dive into that now, but that is the power of position sizing. I know for a fact if we come up to $10 on Pepsi, I'm only going to lose 1 or 2, depending on what my current threshold is, 1 or 2% of my entire trading account. Most people can stomach a 1 or 2% loss there. So that's PepsiCo. Now, I started off this conversation of Pepsi saying there's other ways that we can deflect risk. This would be a bearish trade. We've come up to resistance and we're trading on back. We can also come back to King Kong in this bearish market, United Health. I don't know who their CFO is or CEO, but everybody should be wanting to scoop them up, because if you just looked at United Health, you would not have got the memo that we're in a recessionary bearish catastrophic stock market as the rest of the world has been viewing it. Now, there could be, I don't want to be misleading with all the blue lines on the screen here. You've also got a potential double top that's forming there. So it's not all rose-colored glasses, but generally speaking, again, if we're talking in probability, and this, I may have a better choice than this. I'm shooting from the hip here, but generally speaking, when we came down here, it tended to go up there, right? We came here, it went up there. We came here, it went up there. So we're halfway to that point. So I'm not advocating that you go and enter this trade, but there were some others that popped up on this list that may have been better. ExxonMobil-ish. It's coming up to a resistance. Visa, negative, Ghost Rider. What was I looking at? I saw a couple. There's a good bearish trend for you. JP Morgan. Scott, do you know how rising interest rates impact financial institutions? One would think that they make more money when the interest rates go up, but does that just mean that people are borrowing less money, or they're more likely to default, and the net bottom line is not better? Like, is there any conventional thinking around that?
We could probably do an hour on that, like legit. I mean, like seriously, do an hour conversation around the different ways, and it depends on the firm you're dealing with, and how they're structured. We legit could probably talk this for an hour and really actually get into PowerPoints one day. I only say that because one of the things that has not panned out like it should this time, one, the behavior of bonds, if you've seen this, is, well, historically not supposed to happen the way it's happening. The safety. My son's in college and they met on Monday and they've all talked about, the safe havens all seem to be gone away, and it's disturbing because their hedges are these safety trades, if you will, that are supposed to be protective because they have to take months to make a decision before they execute. And I bring this up, several thoughts you just made me think through going through this, Josh. Sorry, guys. But I bring this up because my son's like, it's not supposed to work like this. I said, no. And even their CIO over the fund has said, who they have like graduate students who come back and help with this. And I'm getting to a really quick point and I'll move forward with this. The interesting part about this is their hedge portfolio, the safety portfolio is actually underperforming their equity portfolio. And that's just not supposed to happen. Just like Goldman, Morgan, JPM really should be in a rising rate environment benefiting from this to keep this in simple terms for people to profit off of. That's what should happen. It's not what's been happening. It's like the system's broken, and you'll hear this through lots of different people, mouthpieces throughout the industry. Something's still not right. The biggest thing I pay attention to are the commercial markets locking up or not, because they start locking up, the Fed's going to be at the, doing their thing really quick, and that's what you have to pay attention to. Most importantly, but yeah, I'd like to revisit that. And you said a minute ago, I just want to remind everybody, please watch last week's episode because Josh does a masterful job of talking about risk. I pound this at people. I beg you to understand it. I get it's not sexy, but losing money is not fun, and you better have your money management alignment. Any professional understands that. If you're new to trading, please go watch last week's episode of this. He does a great job of going through it. So I want to move to Fed boxes. This is the Federal Reserve boxes. I've talked about this before. This is on a 60-minute, just to show you guys the daily, just briefly here. But I'm going to show you this for a reason. That's the daily. The reddish, orangish, magenta looking pinkish color behind how it looks on your screen. Those are where the Fed's actually hiked rates, not cut rates. So that's one that's noted that way. But more tactful or
tactical.
Yeah, sorry. I was looking at something in the corner of my eye when I was trying to say that. I want you guys to have a way to think about taking advantage of the market. So indulge me here as I enlarge this, but you'll see exactly where the market struggled. Now, if you want really solid support resistance places to play against, again, you'll see the gap down. You'll see the retest of this in a minute. I'll walk this through on a 5-minute chart. But guys, these levels are kind of hard to argue with. I've got lots of really cool tricks and things like that, code and stuff like that. The difference is this is publicly available data. You don't need some cool indicator. You just need to understand how we assemble this. But I think most people who are active players in the market, and if you're an investor, there's a whole way of thinking about this. But for those of you going back to how to trade choppy markets is the point of this. I think most of you could kind of figure out what's happening here as price struggles. That you can figure out what's happening at these levels. You have very well defined support resistance. If I shrink this back or bring in more data, you'll see prior support. You'll see a retest that support. Guys, that line is not drawn because I magically put it there. I put it based off the Federal Reserve's data. So if I bring this a little farther back, you'll see when we had the big gap down, the 1,400 point rally, you'll see exactly where they opened down to, where they tested, broke resistance, became support. That's all Federal Reserve based levels the way I have mapped this out. And this has been talked about through our prior classes and on and on. But you can see really solid place to play with. So in a choppy market, if you're trying to play within a zone or within a range, this is that kind of stuff that you can use in conjunction if you have a stock that typically moves in sympathy with the S&P. The concept will work on any single market in the world. You just take the time to go mark it up. But in these choppy markets, it gives us some places to play with and help confirm levels we might be going down to or up to. Until we get out of these zones, guys, as Josh has brought to your attention, as I've showed you with a 60-minute chart a little bit ago, guys, the bottom line, you are in a range. We talked about this back in June, and Josh, forgive me, I'm fixing to kind of hijack the conversation one more time
Go
right here
for
before
it.
we move on. This is all documented back before the June low. We talked about the 0-point turn here before we ever got that. We talked about this because I can text Josh and started breaking down that afternoon. This is about a 5 deviation move down. I bring this up for one reason. This is what I want to drive home. This is consolidating. And it was also against Federal Reserve box and whatever else at that point, some other stuff. Now come forward. What I find with working with traders most often is you see this right here and it's chopping. And I appreciate Josh's topic today. And he can surprise me any session. It's not, we can always run and go with this stuff. What you need to pay attention to most importantly is the fact that you are stuck in a zone and you're getting base hits right now. We're going to come out of this. And when we do, most traders are getting lulled into this, false sense of security, playing the violin kind of thing, wooing you to sleep because the market's choppy. It's going to clear the range at some future point. Set your alerts above the high and low of the range. When it does, go to work. If that is your type trading, because we're going to get out of this range and we will start to move again. I'm surfacing this because I watch a lot of traders. Oh, this time's not going to work. I just know it's not. They hang their head down. They don't take a trade. And the next thing you know, the market's up, 7-8% the next month or two. When you see consolidations, I've preached this for 2 decades in the public domain. Everybody not only will tell you I've preached this back in 2003 and since then easily. When you see consolidations, that is cooling, compressing energy, basing, plateauing that's going to lead to the next move, geometrically speaking. I know Josh loves that term. Don't go to sleep. Prepare for what's coming. Be patient, and then you can get paid. One last analogy on this, and I promise back to Josh on this. The farmer, when does a farmer work the ground? When does he plant the seed, and when does he harvest? He doesn't dig the seed up every 30 seconds to see, oh, you haven't grown yet, pack it back in there. But a lot of people who trade are trying to trade just like that. You think you can will it to do something. Let time work to your advantage. Okay, I'll stop. It's your turn, Josh. Sorry, I packed a lot on that one, but it's true. I see it all the time.
I'm going to come back to this. In fact, I'll mark it here so I don't forget. I want to riff on what Scott was saying, though, in talking about looking at the bottom. I wish I could say I came up with this. I did not. I understand the principles of the VIX, but I had not thought to look this way. And I mentioned at the beginning of the show, we only had a few people that were on now. We've got over 20 here live, which is super cool. Side note, if you joined us late and you liked and subscribed, it would really help us out. And also, that helps us, but what'll help you is if you have a question, type it in the comment section. We see those in nearly real time. It takes about 5 seconds to get to us, as our comment back to you takes about 5 seconds. And we would love to serve you by answering questions. We've got some extra time today, I think. And so if you have a question or you want to look at a stock or whatever, these sessions are designed for you guys. So coming back to the VIX, and you need to understand how the VIX operates to really mine the value out of this. It's called in the news the fear index. And, surprise, surprise, the news doesn't always convey facts accurately. It's not actually a fear index. We have sentiment surveys that go out, and we can ascertain what the level of fear is that people have. What the VIX actually is telling you is what the aggregate implied volatility is of the S&P 500, or specifically SPY. And implied volatility is basically, I'm going to say this because it's not, if you open up a technical analysis textbook, it won't say this, but just for entertainment's sake, implied volatility is like outright bribery to get options traders to sell options. If you have an extraordinary amount of uncertainty coming up in the future, and as the seller of the option, you have all the obligation and none of the upside potential, so to speak, of this volatile move, then you're going to require a pretty penny to pony up this risk that you're taking on, right? Because you have all the risk, and I can't say no reward. There is reward in selling options. By the way, pause here. If you don't know what you're doing with options, please don't go out and sell options to open a position. You will go broke. The market will gladly take all of your money from you. All right. But if there's an extraordinary amount of uncertainty coming up in the future, you're going to require quite a bit of payola to take on the risk of selling an option. The VIX tracks what that implied volatility is. The higher the VIX, the more money that the market makers are having to pay option sellers in order to get them to actually sell an option contract. Okay. Now that we're understanding all that, so if you're thinking, hey, the market might crash, I'm going to really require a whole lot of money comes into my jeans if I'm going to sell you a contract for the right to sell me shares or the right to buy shares at a certain price. So back in 2020, we went up, and I'm going to draw a line across here because these are all pretty similar. Draw a horizontal line. And let's not make it green because that tells me where I got into trades. Let's just make it yellow. All right. So 2020, go back with me, if you will, when we were all locked up in our houses. We didn't know what you could or couldn't do or couldn't say or whatever. And we thought the world was ending. There was a lot of uncertainty out there. And so the VIX skyrocketed. And it was one of the reasons I actually quit right where this cursor is. I quit trading options and I went back to stock. And I've not really gone back to options because I've been enjoying stock trading so much. They were just too expensive, way too expensive to buy. That marked the bottom, right where this peak is on the VIX. That marked the bottom of the 2020 crash. What's the next crash y'all remember? 2009, right? Well, 2007, 2008 is the crash. We're just kind of warming up, boom. Here we go, almost to the same spot we were in the pandemic, just a little bit shy of it, 80 on the VIX. What's the last crash you remember? 2001, right? Not quite as high, 48, and then back a little bit further, 1998, 49. I don't remember personally much before that. I started trading the stock market in 1997, so I do remember these. I can't say that I was a pro back then. I was just stumbling my way through the world. My point is, and I'll mark this one on here too, because these were the lowest. These were the bottoms, and correlate this to SPX. So 2009, there's the crash. In fact, I can overlay the VIX on here. Watch this. Oh, this is going to be amazing. And I need these to be on different scales. Pin to new scale on right. Okay. So, and let's make these very contrasty colors. We'll be patriotic. Red, white, and blue on the screen. Okay. So in blue, you have the VIX. In pink, you have the S&P 500. So here's the bottom in 2009. There's the VIX in 2009. What did we go to before that? 2002, right here. That's the crash started in 2001. I keep thinking where the bottom is, right? We're looking for the bottom. There's where the VIX peaked. Go back a little bit further, 1999. There's the VIX. There's the market bottom. What are we not seeing here today? And I'm not trying to, oops, this is back to the S&P. All right, I marked the yellow lines on where this is the normal scale. The other one, it gets compressed. My apologies for that. So you can do this on your own charts. Go look up the VIX. The yellow one was the lowest back in 1997, 98, that range. And then the 2020, 2009 was up here at 82. It's like we're not even close to that yet. So that's why there's a lot of speculators. I'll call us what we are. There's a lot of speculators that are saying we've not really seen the amount of uncertainty that we would typically expect at a market bottom. I can tell you from experience, and if you weren't trading through it, you might not have picked up on it. The bottoms of those markets that we looked at were frantic. The news media, the coverage was so negative. You would have not thought that it was even worth going to work the next day because the whole economy, the world is shot. We're shutting, like it was terrible. And that's the moment when everything seems like it is at its worst, right? And the uncertainty is at its highest. Bam. That's when the market bottoms and starts going up. Now, here's my encouragement to you. You don't have to catch the bottom. You don't even have to place an accurate trade at the bottom, assuming that you've been profiting during this last year of trading, which has been relatively easy. Remember back, go look up on the YouTubes. Probably 6 months ago, Scott, we were saying, I see head and shoulders patterns everywhere. Like arrogant, misinformed people brag ahead of time, about what they hope their prediction's going to be. Educated, seasoned professionals, we talk about what we actually said. You can go look it up and verify it. And, so it was relatively easy to catch that. So great. We've had an amazing year as traders, not investors. God bless your 401ks. It's okay if you miss the trade at the very bottom because you missed the pivot, as long as you're doing your risk management. Maybe you missed 2 trades. Great. That represents a total of 4% of your account? I know many people firsthand, right? Even the TSU trading account, we're coming up on tripling it right now. I know many others that have doubled their account in the last 6 months or so. We haven't tripled it in the last 6 months, but we're coming up on doubling it in the last 6 months. Right? Tripling it took a little bit longer than that. It is coming up on the tripling. I know that sounded confusing there. That is accurate. A large portion of our success has been during this bearish market. Okay, you may miss 2, 3, 4% of your account when you hit the bottom. So I don't know if you have any thought. Do you do much with the VIX, Scott? And do you have any, feel free to disagree with me. I love it when we disagree because then we can, iron sharpens iron. But that's my perspective on volatility and the bottom.
No, not at all. In fact, it's interesting you brought this up, talking about other people within the industry. I've got a couple of fund managers, and they're perplexed why it's not exploded. I'm like, regardless of what my thought process might be around it, to them it's very annoying because the world's coming to an end. But to Josh's point, if you went back to the flash crash of May of 2010, if you go back to 2000, 2009 especially is a good example of this, which was a significant low. We know that. I get the levels on the VIX, and most people look at the levels. I have a different way I look at that I talk about with the pro group and traction that's been quantified out that I walk through them. I can't put it in here, but I look at VIX, but I spend a lot more time on UVXY, the triple, because the way I have developed that over the past 2 decades. And so I find a lot of value in it, both of those, but it's a very select way I look at it. But it is interesting that it hasn't done more damage, if you will, to the upside, the VIX going crazy and the market going lower based off the world coming to an end. With that said, it's like when you have bad news, good price action earnings. We have lots of bad news, right? Lots of bad news. And the VIX isn't doing what you think it should be doing. Guys, that is the market whispering or talking your ear, chattering your ear, that things may not be what you think they really are. So that's why when we talk about divergences, when I'm looking at trading or trade opportunities, there's not this one size fits all solution. It all depends on the type traders. And realize, I hear this all the time, day traders, man, I just want one thing that always works. Everybody does.
Yeah. Good luck.
Right? I mean, the thing is, it's interesting
I know
because
what
I'll make the
always works,
compare.
Scott. I have an answer to that question. Risk
I,
management always works. You have total control of it.
dude, that's awesome. That's a perfect answer. That truly is. That all, yeah. So I want everybody to imagine listening to us, whether it's now recording, we were all in the exact same grocery store. Do you honestly believe we're all going to buy the exact same food? No. Then why are you asking the market to all act the same way? I understand why you're asking the question, because you want to make money. I've known a trader who only trades the interest rate announcements. So he trades 9, 10, 12 times a year max. Period. Now they're heavier, he's a bigger player and whatever. But everybody thinks everybody's doing the same thing. Warren Buffett is clearly not doing what we're doing in here right now. So it's to give the extreme examples, and everybody wants one system always works. But that's what makes a market a market. Some of you are in here driving your Ferrari very quickly to get from A to B. Others of you are taking the Sunday afternoon drive with the top down because it's gotten cool and crisp out. But you want everybody to act the same way. It's not realistic. And that's why I bring that up. And one more thing we've got to talk about before we wrap up today at some point. What is Friday? What's tomorrow? Third Friday of the month, options expiration. So a lot of what's going on right now in the marketplace going into any kind of options expiration, whether it's regular or a quad witch, whatever it's going to be, you want to pay attention to that, because that's going to drive more of what's going on in the markets right now than technicals, fundamentals, or AI or anything else that's going on out there. Why? Because, well, Max Payne theory. You can look that one up in, I guess, Investopedia. But that's kind of where we are this week. And the movement's both and up and down. And the whole reason I showed this right here with the market watch using the opening range is because now for 2 days in a row, I've watched where the opening range is taking very good care of you, of saying we're not following through. This is one of the things we talk about in trade attraction: price and time. You study Gann, you've heard the term of price and time and squaring of it. You need to learn how to use time stops. Most people don't. Learn how to use the market's own time with price, and most traders don't. That's why counter ranges is time based, opening ranges is time based, your pivots are time based. We could do this for another hour. I won't belabor it, but right now the IWMs continue to not behave right here as it's extending down to a potential target level. The others, the Qs is stronger, and the other two, which is mom and dad, the spies and diamonds, are trying to get bottom back to their session lows, the opening range lows. I won't be surprised to see some sort of attempt at, some reflectivity at those lows. The other piece of this is the Qs are about the midpoint of their opening range right now. But this is not unexpected. And even in Traction Group yesterday morning, I said the next few days, Wednesday, Thursday, Friday, don't be surprised by this. It's just, this is the kind of games that get played, and most traders don't realize it. So that's why I'm surfacing several things at once to try to help you guys see this a little clearer as we go into an options expiration, and just where the market sits in a longer term basis, so that you're not trying to constantly swing for grand slams when there's no one's on base. One more thing on this. A lot of traders don't understand, in the bear market, there's an old Wall Street adage that you basically are going for singles and doubles in the bear market, and then you're going for grand slams in a bull market. We're talking on a macro level. Okay, we're talking much bigger picture than the next 60-minute chart or 5-minute chart you guys will look at. We're talking more from an investor's mindset. And we've already been through that. Now we're on the other side of it, but yet people are still trying to swing for fences. Josh did a great job early explaining this. We're in a choppy market. Take what the market gives you. Okay, I'm watching a lot of traders come in, find great place to take trades from, then they walk away from the trade and it's gone back against them because we're in chop. They were profitable. They just didn't take the profit when it was there at their target because they kept thinking, well, this will be that one time it breaks out. It's possible, depending on the stock and how it's set up. but you're also fighting other things, an election in a couple weeks, an options expiration before then, and you've got earnings season kicking out. And then you've got other issues globally with other central banks that are doing different things. So there's a lot of moving pieces, be mindful. So congrats on y'all's account, by the way, Josh. That's amazing, especially given this year. A lot of people wish they had their accounts looking like you do in the past 6, 9 months. So
Yeah, it's been fun. It's been a lot of fun. It's actually been a lot of fun trading with my boys. So Caden's
mm,
18, Josiah's 13. They both self-funded real money accounts. And um, I have an idea. I'll share it here publicly. I think it's fine. So I think that they were both trading like $2,000 accounts, and margins the best they got. They can finally sell short. They got it worked up to 2 grand. And but day trading is just not possible until you hit 25,000. So I think you'll get a kick out of this, Scott. I'm going to fund an account with $30,000, and I'm going to allocate 10,000 for me, 10,000 for Caden, 10,000 for Josiah. It'll all be in one account, and
mm,
we're going to be responsible for that. And so our R's will be set on what our portion of the account is, and then we'll reconcile it each month. But it'll give us an opportunity to have some powwows at the end of the week and
mm,
say, all right, how did you do? Like, you need to show up and um, be able to advocate for what you did or did not do. So there's two things. There's two reasons this is valuable. So this is trading, and this is parenting here with Josh. Number one, like, how many freaking 13-year-olds are day trading $30,000 accounts? Like, it's just amazing. And they've proven, they funded it, they've grown their account, they're net positive, they've learned risk management. That's the thing I was really, wanting to see in both of them. But then the second thing is, y'all, like, with your kids as much as you can. I don't care if they're big kids like me. I mean, I still have my dad, thank God. Scott still has his dad, thank God. His dad's, really
95.
winning at life. Um, find things that bring you together. Like, talk to your kids about stock trading. They love it. I'm teaching a high school class right now. It's my favorite thing I do. It's tomorrow on, it used to be on Thursdays. They moved me to Fridays. And like, we're still adding kids to this class because word's getting out about how cool it is. And they're just like, Mr. Hesse, can I come just audit your class? I've got a study hall during this. I'm like, sure, come on in. So
Nice.
kids love this stuff, y'all. And I think I was going to go somewhere with that, but I don't remember. I want to give you guys a couple things here. I don't know why I've felt so compelled in this video. Probably should do more of it. Um, again, this isn't trading advice, but I was just going through and scanning some of the stocks. Thursdays are busy for me, so I don't do a lot of trading on Thursdays with our TSU staff meetings and then the trading show and all that stuff. But I was just kind of looking through some of my scans, MRK, Wells Fargo, and ConocoPhillips here. And, it's hard to find a lot of stocks that are sitting right at a triple top right now.
Yep.
And that's a pretty textbook triple top right there. And if the market were to continue trading lower, I would not be surprised if it pulled Merck on down with it. And the other thing I noticed here on a 15 period, and y'all do with this what you want, trade your game, not my game, but just from an intraday perspective, you've got a you've got a wedge right there, or whatever you want to label that. Typically, those are continuation patterns. So we've come down, we've consolidated, on a daily chart. I would expect that to break bearish. I would not expect much different on a intraday chart as well. But the reality is it could break either direction, and I would bias myself to the downside. Okay, if we get a trigger to the downside, I'm a go. If we get a trigger to the upside, not so much. The reason for that is on the downside, you've got targets all the way down here. On the upside, you've just got that little dinky thing. So let's give ourselves the best opportunity for success. Also, Wells Fargo was interesting. I started looking at this, and that's why I asked you, Scott, if you had an opinion on banks. So, just a textbook head and shoulders pattern. This is all like a retesting of that neckline. This is a ascending triangle, which is a relatively neutral. It's directionally agnostic in terms of its breakout, but it's giving you a pinch point for a pivot. So it's either going to go up or it's going to go down at some point. That's the smartest thing I've said all day. It's either going to go up or it's going to go down. And this is not a today trade necessarily, but And well, it could be like you've got quite a bit of room coming on down here. You do have a rising support line that's coming up, so just be aware of that. But I don't think anybody's going to trade this into the new year. We're just kind of looking for a quick little profit there. And then ConocoPhillips, gas companies, I'm not sure what to make of right now. I just saw that, we released a bunch more oil from the strategic reserves here at the US. My hunch, Josh Hesse conspiracy theory, that's probably the last that we'll be releasing because it's going into the election. And after the election, who cares how high gas prices are? It's not as big of a deal. We would rather not run out of oil in the country. I mean, that's a little sensational, but I think they'll put a cap on that. They're trying to temper prices. Y'all understand that, right? So we're just going to flood the market with our oil, anyway, end of rant there. I bet I'm going to cut that one off. I'm self-editing, Scott. Scott's much more politically correct than I am. But ConocoPhillips sitting here at a pivot point. I would be directionally agnostic on this. This sucker could easily break up. It could easily come on down. You're at a pivot point. So I'm showing you that there's an opportunity here. I would let this develop a little bit, but I would say whichever direction it decides to go, it's going to be decisive here in the next week or two, hopefully. ConocoPhillips doesn't just sit around and go sideways for very long. So that was 3 kind of freebies there for you.
Pull up Dixie real quick, Josh, if you can, just a second, the dollar.
Oh my gosh, this is Josiah. I'm going to put this in here. So my son has a YouTube channel called The Space Bar. It's all about modifying keyboards. So Josiah says, Pep is currently in a slightly bullish trend. Do you think that is sustainable? We talked about Pepsi earlier, bud. So maybe that's where that was coming from. But this is that languaging of a 13-year-old. Can y'all believe that? I'm going to put that up there again because I'm proud of it. There you go. So Josiah, this is how I would look at this, and Mr. Scott will give you an opinion as well. I think that bullish trend came to a stop at the beginning of 2022, and I would define that as a sideways trend. This is not a trend. This is not a trend. This is not a trend. Those are moves inside of this sideways trend. So that would be my perspective there. Do you have a different opinion, Scott?
No, I think you're spot on with it. Do you see David's question also on the YouTube?
I do. I love just putting these on the screen. Are you finding that fibs work well in this stagflationary market? David, you know my answer. It's like I love, my God, my wife, my kids, and then fibs. Well, maybe Scott, and then fibs. Like, yes, of course they work. I'm not cheating on fibs. So I love David Ward. For those of you that don't know him, he is, I think, maybe our longest moderator that we've ever had at TSU. He's just been with us for, I think, a decade or more, and he's a dear friend. Very, very wise trader himself. So here's historic examples of fibs working really well, Dave. This is the Fibonacci box based on this move back here. We came and we bounced. We actually called this in the YouTube live in real time, not hindsight. And then we drew this box here, and everybody loves it. I'm going to believe in my head everybody loves it. They're not tired of it. And as long as we traded to or within, but not above that red box, then we were still bearish. We happened to top tick that one. I mean, that's a stud of a move right there. And then we came on down. Now we're at this box right here, which I should move over because it's a little bit misleading. This peak hadn't happened yet. So this is how I got that box. I came all the way down to this big gap down. And remind me what caused that, Scott. Was that a Fed?
Yep.
That was the Fed interest rate? Oh, no, that was the inflation report. It came out. Turned out we were still at 9% annualized.
Yep.
So there's from the bottom of that box, and that could be debatable, but for what we have right now, it's certainly not violated. Anything from here, it gets, moves everything up higher. So that's that red box, which is why I said earlier in the broadcast, as long as we trade to or within, but not above this red box, then I'm still bearish. We could take a look here. In fact, let's just do it while I could maybe tighten that up a little bit if... Okay, so this is interesting. I always debate doing this because I don't want people to say, well, you know, hindsight, whatever. Like, no, that red box served me very well. It's a big red stop sign. Josh, don't trade bullish trades, you know, near this box. It served its purpose. I was using the bottom of this candlestick right here because it worked so well during this time frame. There is something to be said for clarifying the Fibonacci framework as we get more information. And the analogy I use when I teach this in the class is it's like a fancy DSLR camera. In fact, if I can reach the one that's on my thing here, it doesn't work. Where's my focus ring? Oh, it's an autofocus. It won't let me do it. I was going to try to put it out of focus. But if I, you know, shift the ring on this fancy camera, it goes in and out of focus. Well, if my subject matter gets further or closer to me, I need to adjust that focus ring. And so, you know, selecting a slightly different candle here is just like adjusting that focus ring a little bit so we can have better clarity. And if I come down and I measure off from this big candlestick right there, it puts that red box exactly at the pivot just 3 days ago. So I love fibs. I have not found them to be any less effective. I'm curious if anybody's had trouble with fibs during this, and I'm happy to, you know, take a look at what y'all were measuring there. We are at, wow, we're right at the top of the hour, and I do have a phone call in 9 minutes, so I need to not go too long.
I got to throw two things in there before you get done.
Yeah, back to you.
So just pull up Dixie really quick, if you can, on your chart. I want to bring up one thing that's beneficial for everybody, and this is a more macro conversation, then I'll show one thing on my screen after that. So if you've seen if you believe in the magazine headline, you know, cover concept over decades of people, Bloomberg Businessweek put out one on the dollar saying can't stop, won't stop, and Barron's put out one called the powerful greenback. And you can go find these. The Barron's one was, what was it, October's, and I don't know how big Bloomberg's is. I only bring this up about the Dixie because a lot of times, if you know anything about the way markets function, when you see magazine covers, how something won't happen.
It's like a lightning rod.
Right. So now, why do you care about that? If you're a believer that a weak dollar is good for emerging markets, you're starting to look at your emerging markets. Okay. And then think about other things that are sensitive to the US dollar and those sectors. So that's why I'm bringing this up. You clearly have a nice parabolic run in the dollar, but the whole magazine cover, you're going the strongest 6 months of the year, statistically speaking, starting in November, coming out of the poor performing months, election, all these things, guys, in the more macro, big pyramid picture, if you will, for a minute. Okay, so there's that. And I will show one thing on my screen, Josh, and then we'll wrap up. But I'll make sure I don't leave us out today. So when y'all see my screen, you're going to notice there's a bunch of bright, minty-looking green boxes. The thing you really care about on this is really going to be what's on the left-hand side of this, which you'll notice these are all commodity-type related names: Freeport, Cleveland Cliffs, PXD, Schlumberger, Sun, Nove. That's this area versus other things that are moving. And this is basically it's a pivot heat map I had built out. And I tell you this because we're looking at this yesterday in Trader Traction. I'm bringing it again today because those stocks are still performing or attempting to try to perform overall. Maybe not right this second, but in a much bigger macro picture, they're holding up with some strength versus other spaces in the market. So it's just something to think about with what's going on in sectors right now, if it's worth it to look at that for a lot of you guys. The other thing was there's some other names you'll see a little bit more of the salmon color down here that are struggling a little bit lately and stuff like that. But I only bring this up if you're looking for areas to focus on that may see some resurgence. Those might be some areas to take a peek at. So between that and the dollar, pay attention, guys. We'll see. It's going to be an interesting quarter, I think, this time as we wrap up. So I appreciate you, Josh. I appreciate everybody being here. Thank y'all very much.
Right on. I think Scott said it best. We're going to go ahead and head on out of here with a disclaimer. Reminder that it's all for educational purposes only, my friends. Please trade wisely. Trade with your stops. Use risk management principles. Just don't be dumb. There's the quote of the day, Scott. I love you, brother. Thank you for doing this together with us every week. We'll see you guys same time, same place next week. Thanks for the 60 people that joined us live. If you would like, subscribe, and share the broadcast, it'll help us get the word out to more and more people. Blessings, everybody. We'll see you next week.